MIRAI Corporation. Financial report for the second fiscal period and the midterm management plan. Section 1. Topics in the second fiscal period. MIRAI is a diversified J-REIT listed in December 2016, dual-sponsored by Mitsui & Company Limited, a representative major general trading company in Japan, and Idera Capital Management Limited, an independent real estate asset management company. MIRAI has acquired and operated 15 properties, mainly office buildings in the Tokyo metropolitan area. Our portfolio totals 100.7 billion yen. Due to our active promotion of tenant leasing, the occupancy rate of the portfolio has increased from 98.1% at the time of listing to 98.9% at the end of April, which means almost full occupancy. The unit price has been hovering below the initial public offering price of 183,000 yen, and the DPU yield from the unit price of 162,000 yen at the end of May was 6.3%. Section 2. Outline of the financial report for the second fiscal period and our future forecast. The operating revenue in the second fiscal period has essentially remained as expected. However, the utility revenue fell below expectations, and the result was a 90 million yen decrease compared with the forecast. NOI met expectations at 1.81 billion yen, as the utilities expenses decreased to a similar extent, which absorbed the decreased operating revenue. As a result, the net profit in the second fiscal period was 1.04 billion yen, and distributions per unit were 3,260 yen. For the third and subsequent fiscal periods, the operating revenue is forecast to increase dramatically as income from the rent business becomes stabilized. Although the fixed property tax is anticipated to be imposed on us from the third fiscal period, we still anticipate that the income from the rent business will increase by 550 million yen thanks to the full-year contribution of operating revenue. In conclusion, we forecast that the net profit will be 1.5 billion yen and distributions per unit will be 5,100 yen in both the third and fourth fiscal periods. A flagship property of MIRAI, Shinagawa Seaside Park Tower, is a high-specification office building with a standard floor area of about 1,650 square meters. This building is directly connected to Shinagawa Seaside Station and can be accessed with only a 1-minute walk. The location is very convenient with easy access from Haneda Airport and JR Shinagawa Station, and therefore has high competitiveness as a business base. The shopping mall, Oval Garden, has a variety of restaurants, and the Aomono Yokocho area, where the atmosphere of the ancient major road or Tokaido remains, has hidden, well-established stores that offer many lunch options, which is another point of appeal for tenants. It is very advantageous for clients to be in an enriched office environment at a rent level that is about half of the CBD of Tokyo. In the past, Shinagawa Seaside Park Tower was packed with IT companies. As the vestige of that, we see such cases where one company's headquarters moved there from nearby Osaki, and another company gathered some back offices from Chiba City. Recently, some tenants have moved their headquarters there from Roppongi, Shibuya, and other CBDs of Tokyo. We can see that many companies are located in the Bay Area in consideration of the balance of function, convenience, and rent for the office building. The Bay Area in Tokyo is a sub-market for offices. However, we can see many office relocations into the Bay Area from the CBD of Tokyo. Therefore, we believe that we can run the rent business stably by reducing risk of cancellation through tenant diversification. The current tenants of Shinagawa Seaside Park Tower include the headquarters of Mercedes-Benz Japan, which holds the top record of imported car sales volume in Japan, Big Globe, a KDDI-affiliated internet service provider, and so on. Kawasaki Tech Center was originally constructed as a facility dedicated to data centers. Therefore, this large office building is equipped with advanced security functions and disaster prevention measures such as emergency generators. Due to the renewal of the north gate of JR Kawasaki Station, Kawasaki Tech Center is expected to become more accessible and convenient, with less time needed to reach the station. We have refurnished the lighting in the common areas to LED lights, renewed the carpets, and more to enhance the appeal for potential tenants. That led to our current leasing performance, and we anticipate that it will achieve an almost full occupancy. Since the rent is relatively low compared with the other similar function and convenience office buildings, we also expect stable rent in the future. AEON Kasai is a large retail property located near the CBD of Tokyo. It was opened as the first shop of the former Jusco in Tokyo and has become a strategic outlet for the AEON Group. It has been playing an important role as a pioneer shop for senior citizens. AEON Kasai is approximately 15 minutes from Otemachi Station on the subway Tozai line and features a very convenient residential district as its trade area with an increasing population. The shop opens at 7 a.m. on weekdays and is a popular facility where senior citizens can enjoy fitness, Japanese board games Igo and Shogi, and a cafe. The shop has enjoyed increasing sales since its renewal and won a prize as a base that supports the local community. Shibuya World East Building is a retail property that is a 1-minute walk from one of the Shibuya Station exits. It is adjacent to large retail buildings and located at the entrance of Cat Street, which features unique shops. Therefore, many people come and go on both weekdays and weekends. Shibuya Cast, which was developed by Tokyu Corporation and other companies, opened in April 2017, and the Miyashita Park redevelopment business is planned for 2019. We anticipate that the area around the property will become more crowded as the redevelopment proceeds. The select shop Rosebud, which is mainly popular with young women, is located on the first and second floors. We have already confirmed that most of the tenants that will need to renew their contracts in the third and fourth fiscal periods have intentions for renewal. Therefore, we anticipate that the occupancy rate will be 99% or higher. Most of the retail properties and hotels, which account for about 30% of MIRAI's portfolio, are leased under long-term fixed contracts. Therefore, the rent will not be revised in principle at the moment. On the other hand, most of the office properties are leased under short-term general lease contracts, which is common in Japan. However, many tenants have relocated into our properties in the last few years, so we forecast that the risk of cancellation and the rent income reduction risk are small. To respond to social requirements for environmental issues, we are promoting environmental and energy-saving measures in our portfolio. Shinagawa Seaside Park Tower has a DBJ Green Building certification, saying highly excellent environment and socially conscious building from the Development Bank of Japan, or DBJ, which is wholly owned by the government. We have been striving to take environmental measures and reduce costs in our portfolio. For example, in Shinagawa Seaside Park Tower, we have implemented construction to change the lighting in its common areas, such as the entrance and elevator hall, to LED lights to reduce power consumption to about 1/3. As to debt procurement, MIRAI repaid the short-term debt of 2 billion yen in the second fiscal period, refinanced the same amount for the 7-year long-term debt, and opened an account at Mizuho Trust and Banking. Regarding the balance for the short-term debt, which is about 7 billion yen, we plan to repay 2 billion yen using the consumption tax refund. For the remaining 5 billion yen, we are waiting for the right time to refinance it for the long-term debt. MIRAI has established a robust lender formation with Mitsui Group financial institutions as the main banks, and are proud of our extremely high competitiveness regarding the financial stability and financial arrangement conditions. MIRAI has gained publicity in the market through media exposure since listing, and has been actively promoting one-on-one IR for domestic and overseas institutional investors, and event exhibitions for individual investors. To respond to demands from global investors, our website supports Japanese, English, and Chinese, and has completed AIFMD registration, which enables us to do IR activities in Europe. In the future, we will continue to increase our opportunities for various types of media exposure and deliver up-to-date information in an easier-to-understand manner through our website. Section 3. Midterm Management Plan Repower 2020. The unit price of MIRAI has remained below NAV per unit since IPO, and we recognize that it is difficult to seek DPU growth dependent on capital increase alone. According to positioning analysis, which compares our competitiveness with other J-REITs, MIRAI has distinctive financial stability while being inferior in portfolio diversification, profitability, and liquidity. Therefore, we must address those issues. MIRAI has developed the midterm management plan Repower 2020, aiming to return to the growth path, and strives to address those issues. In Repower 2020, which aims to return to the growth path through the sustainable growth of DPU and strategic operation, we set goals as follows. While maintaining the occupancy rate and rent level in our portfolio, we will increase unit holders' value by raising DPU in a step-by-step manner, from the current stabilized level of 5,100 yen to 5,700 yen, via external growth and a portfolio reshuffle. To maintain and increase profitability of our portfolio, we will increase the NOI yield after depreciation to 4% or higher, and decrease the investment ratio of the top 3 assets to 40% or less to reduce the concentration risk, and control the leverage ratio under 50% to avoid excessive risks. 70% of the portfolio of MIRAI consists of large offices, and the remaining 30% consists of retail properties and hotels. Under current market conditions, we see the yield compression especially in the urban office properties. Therefore, we will strategically shift the investment allocation to 60% of offices, 30% of retail properties, and 10% of hotels, aiming to increase the NOI yield after depreciation to 4% or higher. Regarding our investments in offices, we will avoid the 3 wards in the CBD of Tokyo because the price hike continues with concern of oversupply. Essentially, we will take careful considerations for the concentration risk of large properties by taking such measures as co-ownership with sponsors and so on. MIRAI will also consider selling partial interests of properties with high investment ratios and buying new ones for reshuffle. Regarding our investments in retail properties, based on the premise of a long-term contract, we will only invest in highly selected properties with local competitiveness. For properties that require revitalization, though we must monitor the stability of cash flow carefully, we can expect high profits from them, so we will carefully consider them as core plus assets. Regarding our investments in hotels, we will continue to invest in business hotels and economy budget hotels because steady demand is expected. For hotels in the 3 major metropolitan areas, we will make careful judgments because an increasing number of properties have been newly developed. For rural properties, based on the premise of a long-term contract, we will only invest in highly selected properties based on the operator's credit strengths and the situations of nearby competitors. In this way, we will aim for further improvement of profitability, targeting an increase in NOI yield after depreciation of 4% or higher. Mitsui & Company Group plans to compose the private REIT by the end of fiscal 2017. Property co-ownership and joint operation make it possible to invest in very large properties that MIRAI hardly does alone. The property and tenant concentration risk can also be reduced by decreasing the investment amount. The reduction of the concentration risk and improvement of profitability can be realized simultaneously by switching our possessed properties to co-owned ones. DPU in the second fiscal period is 3,260 yen, which is almost the same as the initial forecast. DPU forecast in the third and fourth fiscal periods will maintain the value forecasted at the time of the IPO, that is, 5,100 yen. Although tenants that need to renew their contracts within a year account for 20% of our portfolio, we anticipate that the almost full occupancy will continue and the rent will remain on the same level. MIRAI has set the midterm management plan up to April 2020 and will operate the portfolio targeting a dividend of 5,700 yen or more. MIRAI will promote portfolio diversification and improvement of profitability, which are our business issues, and will run our business aiming to return to the growth path.